Welcome to today's stock analysis, where we delve into the impact of the AI revolution on two noteworthy companies, Google and IBM. Our focus is on assessing their intrinsic valuations using 5 distinct models. By employing these analytical methods, we aim to uncover potential investment opportunities and identify compelling valuations. To streamline this process, we've developed an automated analytical spreadsheet, which not only facilitates our analysis but is also available for you to explore on our Patreon page. If you're keen to apply these valuation models to your favorite stocks, the spreadsheet link can be conveniently located in the video description below. Let's dive into the intricate world of stock analysis and discover what these insights reveal about Google and IBM. Now, we've seamlessly integrated the ticker symbols for Google and IBM into our spreadsheet, automatically importing the relevant stock data. Examining the 720-day graph, we observe a notable upward trajectory in both stock prices over the past year. Google has surged by nearly 60%, while IBM has shown a robust increase of close to 40%. Shifting our focus to valuations in comparison to target prices, Google appears to be approximately 15% below the mean analyst target price, signifying potential undervaluation. Conversely, IBM aligns closely with its analyst target price, suggesting a valuation in line with market expectations. Both stocks exhibit an RSI around 50, indicating a balanced state with neither being oversold nor overbought. Now, let's delve into a more detailed analysis of the intrinsic values for these two stocks, utilizing the 5 distinct intrinsic valuation models embedded in this spreadsheet. This exploration will provide a comprehensive understanding of Google and IBM's intrinsic worth. Our initial stop in the realm of intrinsic valuation brings us to Graham's revised valuation model, a creation of the legendary Benjamin Graham. This model enables us to determine intrinsic value based on 3 key inputs: earnings per share, the anticipated growth of the company, and the current yield of a AAA bond. Fortunately, our automated spreadsheet streamlines the process, requiring only the addition of the company's projected growth, readily available on platforms like Yahoo Finance. Upon incorporating the projected growth for Google into this model, the intrinsic value calculation yields $122.01. Remarkably, this indicates that Google's intrinsic value is approximately 15% below its current stock price. Applying the same methodology to IBM, the intrinsic value computation results in $69.82, revealing a substantial undervaluation of 61% relative to the current stock price. Moving on to the next valuation model, we explore the Peter Lynch Dividend Adjusted Fair Value Model. In this method, the Peter Lynch fair value is determined by adding the earnings growth rate and the dividend yield, and then dividing the result by the price-to-earnings ratio. The output is a value either above or below 1, where a value below 1 suggests an overvalued stock, while a value above 1 implies an undervalued stock. Upon applying this model to Google and IBM, both stocks exhibit a Peter Lynch fair value below 1, indicating that they are currently overvalued. To refine this assessment, we perform additional calculations, although I won't delve into the specifics in this video, to derive a more tangible fair stock price. For Google, this computation yields a fair stock price of $97.03, falling below its current stock price. Similarly, IBM's fair stock price is calculated at $20.93, once again coming in lower than its current stock price. Now, let's delve into the comparable company analysis, also known as the multiples valuation model. This approach involves identifying companies similar to the one under scrutiny and utilizing their price-to-earnings ratios to calculate intrinsic value by multiplying with the company's earnings per share. In our analysis, I've included comparable companies for both Google and IBM. Focusing on Google, the intrinsic value derived from this model stands at $144.83, closely mirroring the current stock price. Shifting our attention to IBM, the calculated intrinsic value is $171.67, slightly below its current stock price. This comparison unveils interesting dynamics, suggesting that Google is currently trading at a valuation in line with its industry peers, while IBM might be experiencing a slight overvaluation. Now, let's explore the dividend discount model, a method that delves into a company's dividend payouts over recent years. We calculate an average dividend growth rate, and this, along with the discount rate, is used to determine the intrinsic value of the stock. The spreadsheet also offers the flexibility to input a custom dividend growth rate, allowing for adjustments to be more conservative, if desired. In the case of Google, which does not issue dividends, this model cannot be applied. However, for IBM, a company with consistent dividend payouts, we leverage the quarterly dividend information available on Yahoo Finance. By incorporating these quarterly payouts and setting the payout interval to quarterly, we obtain an average dividend growth rate of 1.41%. Utilizing a discount rate of 7.5%, the calculated intrinsic value for IBM comes in at $110.49. Notably, this intrinsic value falls beneath the current stock price, signaling a potential overvaluation. Our final stop on this intrinsic value journey brings us to the discounted cash flow model. This model values a stock by estimating its future free cash flows, discounting them to present value using a chosen discount rate. It then factors in total debt, adds cash and cash equivalents, and divides the result by shares outstanding to determine the intrinsic stock value per share. For Google, we can source the necessary data from Yahoo Finance, including cash and cash equivalents, total debt, shares outstanding, and free cash flow data available online. When we integrate this data into the model, the intrinsic value calculated stands at $306. Remarkably, this is nearly twice the current stock price. On the other hand, applying the same methodology to IBM, the model yields an intrinsic value of $143, which is 20% under the current stock price. These diverse intrinsic valuation models provide us with a comprehensive perspective on the intrinsic values of Google and IBM, offering valuable insights for investors seeking a deeper understanding of these stocks in the market. In the summary section, we've assessed and compiled all calculated intrinsic values for Google and IBM, making strategic decisions on which valuation models to include in the final calculation. For Google, the exclusion of the dividend discount model, given Google's non-payment of dividends, results in a final intrinsic value of $167.36, representing a 16% premium over the current stock price. Acknowledging the inherent uncertainties, a margin of safety of 20% is incorporated, leading to an acceptable stock price of $133.89, below the current stock price. In the case of IBM, the decision to exclude the Peter Lynch dividend adjusted fair value, considered an outlier, refines the intrinsic value to $123.84. By applying a margin of safety, the final acceptable buying price hovers just under $100, significantly below the current stock price. In conclusion, neither stock presents a clear-cut attractive buying opportunity. However, according to the calculations, Google emerges as the more favorable option, considering that the difference between the current stock price and the calculated intrinsic value is the smallest. Closing this video, I'd like to highlight that the intrinsic valuation tool featured in this analysis is available on my Patreon page, along with other tools designed for stock analysis and portfolio tracking. For your convenience, you can find the link to the page in the video description below. Now, a crucial disclaimer: I am not a professional financial advisor. The stock analysis presented on this YouTube channel is intended for informational purposes only and should not be construed as financial advice or a recommendation to buy or sell any stocks. Always conduct your own due diligence and seek professional advice before making any investment decisions.